Hello everyone, my name is Kamal Manocha. I am CEO with PMS Aif World. For last almost 6 months since lockdown has started, we have been doing a lot of webinars. We have been running a lot of webinar series and have invited many fund managers to understand what's really going around and to understand, how products should be picked. Lot of wisdom has been picked over these webinars. While we have been doing around couple of webinars in a week, we have besides while we were not doing webinars during the week, we have been acquiring a lot of clients. We have been doing a lot of wealth management services, and today we have more than 115 HNI ultra HNI families. So we have a history. We have been operating for last almost 2 years. So based on a lot of learnings and experiences, we started PMS Aif World, and then over the last 6 months we have in fact acquired more than 22 HNI ultra HNI clients. So while we were doing these webinars, we were suggested by our clients that why don't we come out and speak out loud and out on what we are doing, what values we are, what value add we are adding towards our clients, towards our investors. And then we thought around it, and then we thought, let's do an open webinar where maybe our clients can talk to us, and we can also understand from them in the open discussion what are the clients questions, and we can answer them in that regards. How do clients see us, how do clients understand us, and what really is it that clients are valuing about us. So today, in a very, I would say, unique format, we have Miss Sapna Bhavnani, who comes. I think I would want our dear clients to introduce themselves on their own, and we also have Mr. Akhil Jain. So I am not a moderator. I am kind of now on the other side today. So I would like to answer questions, and over to you, Miss Sapna and Mr. Akhil Jain.
So,
All right.
Akhil, I'll let you start.
All right. Hello. Thanks, Kamal. Hello, Sapna, and everybody. And have extensive experience implementing large ERP projects for Fortune 500 companies. Budget for the projects that I led varied from 500,000 US dollars to $20 million. I was in US for 20 years before returning to India 2 years back. That's my professional background. And from my investing standpoint background, I really started investing seriously around 1.5 years back. Up until that time, I used to invest in the market, lose some money, get out of it, wait 5-7 years, and then go back into it, lose like that. But then around 1.5 years back, I decided to get an advisor to help out with my investing. So that's me. Over to Sapna.
Okay. Good evening, everyone. I'm Sapna Bhavnani. I think Kamal would have a spectrum of clients. I think, like he said, he usually works with the HNI category. And I guess the category is like a spectrum of people across businesses and professional services. So I'm more on the professional services side. I lead public relations for a French multinational that is headquartered I manage the Asia Pacific region out of Singapore, but I'm currently based in Delhi. My relationship with Aif World actually goes back to maybe like 7 to 8 months ago when I was looking for a new financial advisor. So I have been working actually with an advisor for about 5 years. And while it wasn't a bad relationship, and it's not that I didn't see my money grow, I think I wanted my money to work harder for me. And I was specifically looking at introducing PMS as an investment product into my portfolio. And that's where Kamal and PMS Aif World comes in. As far as I go and my investment journey goes, so I think a little bit like Akhil, I have been investing, like over the years, and I think it's been a good business. But I think 1.5 years ago, when I started seriously looking at my portfolio and rebalancing it, and to see how I could make my money grow, work more for me. And that's where Kamal and his services come in. And maybe I think to tell a little more of exactly what Kamal and his organization does, I think we'll change the focus from Akhil and myself, and give the floor to Kamal, perhaps with the first question that I'll address to you. Kamal, I think, leaving, and most of us come from, like solid corporate careers. So do you. You have a career in investment banking, a background of investment banking from Citibank. And you left that at the heights of your career to kind of, go off on the entrepreneurial journey and form PMS AIF World. So what exactly is your vision for the company, and why did you feel you wanted to leave the corporate and actually start advisory services on your own?
Hello. Yeah. So, Citibank really, was a very, very good learning experience. And I spent there almost 10 years. Having worked there, I learned a lot and in multiple roles. However, I realized that working in a multinational bank, an institution, there were a lot of limitations. You cannot work in with a lot of controls, and ultimately, the fact is that this industry is not designed to be fair. Financial services industry, there is a lot of work that one needs to do before a product is supposed to be suggested to an investor. Industry primarily focuses on kind of sales oriented ways of working. So when you approach a bank, it's basically a service. It is a company which is providing a lot of services, and hence eventually from an institution's perspective, their core objective is to ultimately maintain a relationship with you. So to maintain a relationship, the traits, the drivers of maintaining that relationships are always around doing sales. Because to maintain a relationship, you would kind of uh, get into things like Happy Diwali, Happy New Year, Happy Birthday. All these are kind of more around sales. But having worked more towards investments, I always aspired to kind of focus more on performance and less on relationships. So that is where I thought that there is definitely a gap. So I'll give you an example. Over last 6 months, when we have seen equity markets being volatile, they were down, they were up. Industry primarily would be, I think, selling kind of debt products. It would be selling arbitrage products. It would be selling maybe LIC assured return products, because it is easy to sell. These are those products which would maintain relationship with the client, with the investor. But it's nothing to do with performance. When it comes to doing with performance, it requires taking some ownership, taking some control, and focus has to be on performance. The secret is that unless you focus on something, you cannot achieve it. So if focus is relationship, you will do sales. If focus is performance, you will do analysis, and that is where I wanted to create a difference. So when we started off, we started off as a wealth management company, right? AdviceSense Wealth Management. However, to actually deep dive the space of PMS and AI products, we created PMS Aif World, where we thought that let us understand what are the 5 attributes to understand a portfolio. We found that one of foremost criteria is to understand people, then philosophy, then portfolio, then performance, then price. So to understand it, to deep dive it's very, very important to actually meet the fund management team, talk to the fund management team, know what they do, and not just once, maybe do that on ongoing basis, because people keep coming in, people keep going out, thoughts keep changing. So that was the reason behind setting up PMSAI World. Because maybe over a course of this discussion I will share more that how and why name PMSAI World was kind of thought. But in nutshell, if I have to say, if the industry is focused towards relationship, we focus towards performance. If the industry to do relationship management focuses more on sales, we do more of analysis, because our end goal is performance.
Thank you, Kamal. I do see, I think that my camera is frozen, but I hope that everyone can hear me clearly. Kamal, you made a very interesting comment on, performance versus relationship, because, for me, I think a lot of wealth advisory services also centers, around relationships, because people actually trusting you with money and advice regarding, their money and how to best make it grow. And I think, you'll possibly, I'll hand over the floor now to Akhil to maybe direct a few more questions to you where you can clarify how, with the mix of PMS AIF World and AdviceSense, how actually you balance both sides of the equation. Akhil, to you.
Thanks a lot, Sapna. Kamal, my question will be kind of piggybacking on what you just said. Um, I have a question on market positioning. Having worked for 25 years, I understand every business evolves over time. How do you see your positioning currently? In where do you see it growing in the future? Like, are you a wealth manager offering various investment products, or an investment advisor working like a detective with clients to find the best products out there, investment products? Or are you an investment firm that offers its own advisory products as well as offers investment products from other AMCs? How do you see yourself today and going forward? Come over to Kamal.
Right. So, so basically, as you rightly mentioned in the beginning of your question, that every business evolves. So we are also evolving. So I would say my background is that, when I was working in Citibank, I was working as a reseller. Then briefly, I definitely worked as an investment advisor. So where, like you rightly said, being an investment advisor, one works like a detective. I work like that. So I saw, both those aspects, both have their pros, both have their cons. And then, when we set up this institution, we today in the current capacity, we are also working as a reseller. But our ethos are more towards analysis. And in the current context, when we say PMS Aif World, PMS Aif World is a platform which basically provides unbiased information, which basically provides an open architecture to provide information regarding all the PMS and AI products, so that it's not just closed to one or two products selling. It's about talking about each and every product, providing every portfolio manager an equal platform to come and showcase one's performance, and not just maybe few couple of products. So it is more to do with informed, helping investors take informed investment decisions. But having worked both as an investment advisor and having worked both as a reseller, I can tell you in the near future we are going to apply for a corporate advisory license, and then we'll have both departments. So all that work is already under process, and that is the reason we have AdviceSense Wealth, as well as we have PMS Aif World. In the current context, we say that AdviceSense is our investment philosophy. And I will cover that, what is our investment philosophy, and it's quite fine, and it's discovered based on decades of experience, and it's working very well. And why we say that, when we are saying high performance investing, because we want to deliver that. Being an investment advisor, one more or less covers a very rhetoric role. I have done that role. When you work like a detective, and when you work purely like an investment advisor, you tend to not take much risk. You tend to become too risk averse, because it's like giving a prescription. It's like giving just an advice. And when markets would be down, you assume things like COVID. It would be just kind of recommending investors that you just sit tight. You will never put your skin in the game, right? So that is a very unknown reality about only working as an investment advisor. So you have to, and moreover, from the perspective of clients, it's ultimately a business. An investor will also value your services when you're providing him a solution. If you provide him a solution, only then he will obviously pay you a fee, or pay you kind of in form of a distribution fee, or pay you advisory fee. So Sebi is definitely trying to address the conflict of interest, but it's not to do with the mechanism of paying fee or earning I would say a distribution fee. It's more to do with actually putting one's ownership in terms of delivering value to the investor, so that value investor sees, and he happily kind of pays a fee, or he happily understands that this is the equation that he shares for a particular percentage, or for a particular fixed fee that with the investor. So whether it be in form of a distribution, or it be in form of an advisory. So that is where, from our context, our focus is more towards adding that value in analysis, adding that value in addressing all the questions of our investors as they come off and on, because it is an ongoing relationship. Adding value in terms of hosting all these webinars, where we call all our clients as well as all our money managers. And then when investor sees that value, ultimately he finds that, yes, I have made money based on the value. There is an institution which is taking so much pain in not only just suggesting me a product, is also always available to answer my questions. And it's not that the answers are given by the institution. I can talk to directly fund managers to get answers to my questions, and a very, very high quality content, very, very high quality discussion is what ultimately provides investor high conviction. And that is where he's able to hold on to his investments. And ultimately, based on one's 1, 2, 3 years of experience, one realizes that yes, it's high conviction that matters equally as it is while choosing the product. So to answer to your question, we are at the moment acting as a wealth management firm, which is basically providing products, solutions, ultimately with the end objective of investor achieving high performance.
Excellent. And I can vouch for that. And I've been working with PMS AIF, investing through you guys for the last 4 months. And I've seen that your focus is a lot on performance, and it's very objective, looking at past performances and investment philosophies of the fund managers, and the education aspect as well, as you mentioned, where I feel myself I'm a lot more educated about where my investments are placed more, and as a result comes more conviction. So now let's go to Sapna for the next question.
Okay, so I think we've been speaking about Kamal and PMS Aif World. So let's turn attention back to maybe the spectrum and the kind of audience that we have, which is largely investors. Kamal, you've been in the space for many years, and you would have dealt with a variety of customers and investors. Now, what, in your opinion, do you think investors need to keep in mind to actually create wealth over the years? What are the factors that are the most important for them?
So, okay, so to answer to this question, I would first share some of the fine understandings that I have got after having worked in this industry, as a wealth manager, as an advisor for almost 15, 16 years. The foremost aspect is that investors, when they invest in equity, they first think of, whenever you ask anyone that, when you are investing in equity, the first thing that comes to their mind is always risk. Whenever they think of equity, they first think of risk. One should ideally realize that when one is not investing in equity to think of risk, one is investing in equity to ultimately think of returns, because returns is the core reason to invest into equities. And this is very, very fine part, which is very, very difficult to actually implement. You think of a scenario like it happened in the month of March when markets were down, and you were wanting to invest into equity. You will always first think of risk whenever you are thinking of investing in equity, and that is the biggest mistake. Secondly, when it comes to investing into debt, investors first think of return and then think of risk. That is again another very, very I would say fine aspect when one needs to understand that when one is investing into debt, the ultimate objective is safety. Ultimate objective is not return. So one should think of risk first and return second. Primary thing is risk and secondary thing is return. Today, when debt returns are low, investors are not very happy investing in debt. They are. I can tell you that I would get calls from investors who would say, I don't want to put money into debt fund because returns are low. I don't want to put money in equity. To give me an alternative which is safe but provides me higher returns. Ultimately, with this, investor will land up taking some kind of a structured product or some kind of a bond or some kind of a concentrated risk, which will be very high on risk. So and that eventually will reduce his appetite to eventually take risk, when which is required to take in equity. So the foremost aspect, the foremost understanding which investors need to keep in mind, that whenever they think of doing asset allocation, which is the foremost theoretical discussion which is done by most advisors with their clients, is to keep in mind that debt has to be seen from the context of first risk and then return. Even if returns in debt are 4 or 5%, that's fine. One has to first think of risk and then return. And similarly, when it comes to investing into equity, one has to first think of return and then think of risk. Because unless you first think on return, you will not be able to invest at right levels. So in the month of March or maybe April, May, when markets were down, if one was to invest to make money to think of returns, one would invest into equity because levels were so low. valuations were relatively low. If your objective is to actually make money, you will think of returns and you will invest. But if you will think of risk, you will never be able to invest. So this is the first aspect. Second aspect is, which mostly theoretically everybody understands, the recency bias. But I'll tell you how it actually spoils and how it actually leads to a lot of issues. So when assume in the month of March, when COVID had hit, levels were down, levels were low, you are wanting to invest. What you will do, you will see the past performance of a fund, and the past performance of the fund will kind of be very, very low. It will be, in the month of March, obviously Nifty levels were 7,500, Sensex levels were around 25,000. Any good equity fund, you see the returns were very low. Seeing that past returns, you will never invest. So this is not just a recency bias, but the fact is that you are focused too much on past performance. Performance is not the only measure that you need to keep in mind when you're investing. So this is the second most aspect. When you have understood that yes, when you're investing in equity, you have to focus first on return. Now, when you're focusing on return, it does not mean that you see the past performance when you're investing. Obviously past performance does give you a very good measure to understand how good or how bad a fund is, but it does not really mean more than that. It does not answer to your question. So focusing on past performance and investing will basically make you invest now when markets are very high. So for someone who is investing for long term, maybe these levels are also not wrong, but it's not that you cannot understand or take a decision of investing based on your past performance. So beyond performance, you have to understand portfolio, you have to understand philosophy, you have to understand who are the people behind that fund, how many times fund manager has changed, you have to understand the price, what is the expense ratio of the fund. So you have to understand valuations of the portfolio. So if one understands one's behavior, point number one, I'm just giving a crux to it, that yes, whenever I'm thinking of investing into equity, I will first think of return and then think of risk. So when I think of return, maybe in current context, when markets are high, I will think that yes, in long-term context, now valuations are high. We are at close to all-time highs. Returns maybe over 1 year, 2 year may not be that great. So my focus is on return. I will slowly, gradually invest into equity. Not maybe I will not be very gung-ho about equity if I'm investing for maybe near term, 1 or 2 or 3 year horizon. So similarly, if we were to see a scenario like March again and markets are down, and if my focus is on return first, I will definitely invest into equity, because then I will say that yes, at these levels now, maybe if market falls by 10% more, does not matter, but I am focused on return. I'm not focused on risk. And once this behavior is attained and this behavior is practiced and it is done for 2-3 years, the results itself will give so much confidence to investor that he will kind of, it's like when you are doing gymming, when you are doing fasting, when you're doing you want to achieve something and you see results, you get a kick, you get motivation, and then that actual self-learning is something that teaches you a lesson forever. So if one follows this first aspect, it will give such a good motivation in terms of performance. Like maybe it would have given to some of our clients who have understood and who have associated with us, and with us they have actually worked to understand this equation. One will make money. And then obviously second aspect, which we say as 5P analysis, which is definitely deep diving the product, not only on the basis of performance, but also understanding the philosophy, portfolio, price, and people behind the product. These are the two fine aspects which investors follow, and then they can definitely create wealth.
Thank you, Kamal. I think with that, maybe like Akhil, I hand the floor back to you for the next question.
Yeah, thanks, Sapna. Kamal, my question is, maybe it's a more basic question, but piggybacking on what you said, I'd like to know, when it comes to investing in different vehicles, what difference do you see between mutual funds, PMSs, and AIFs? Does one vehicle stand out compared to the other when when you perform your 5P analysis? And also, I'd like to know how you arrived at the name PMS Aif World.
Okay, so mutual fund is a very basic product. It's one of the very well regulated products, and a product which is well diversified, meant for beginners, meant for retail investors, and is meant for that pot of money where one wants to actually take low risk. When I, in the last question, explained the equation of risk versus return, maybe, when one is investing in debt, where the first objective is risk, there maybe mutual fund is a very, very good structure, because ultimately it's well diversified, it is very well regulated, it works on common measure of one NAV, and hence quite transparent. So for the pot of money where one wants to definitely attain a low risk strategy, mutual fund is a very right structure. However, when it comes to creating wealth, mutual fund there also follows a very, very good performance. However, it's not the best structure, it's not the most conducive structure, because you are ultimately owning units, you're not owning shares, you're not ultimately becoming shareholder by being by investing in mutual funds. So for when you're wanting to do high performance investing, maybe the debt portion should go into debt mutual funds, and equity portion should go into beyond products beyond mutual funds. That is where that equation of a very clean debt and a focused portfolio of stocks is what ultimately helps you create wealth. So to answer to your question, and then maybe differentiate between mutual fund and PMS. So when it comes to investing in mutual funds, there are so many investors who are investing together, and then when everybody invests together into mutual fund, it kind of works where there are too many behaviors trying to chase a common goal, a mutual goal at a time, and money comes in, goes out, too much there are at times redemption pressures. Money is coming every day, maybe in form of SIPs. Fund manager has to invest that money, he cannot sit on cash. So it definitely provides some limitation to the fund manager in that context. All these aspects are not there when it comes to a very focused product like a PMS, because in a PMS it works on the concept of a demat account, which is separate for every individual. So obviously for somebody who is wanting more standardization, that is offered in a mutual fund product. But somebody who really wants a customized, a focused portfolio, a more concentrated portfolio, a more portfolio where fund manager is more hands-on, that is a portfolio of a PMS, right? Where too many investors are not investing together. It's every portfolio of each investor. So if two investors together invest together in a PMS, their separate portfolios are created. If one investor wants to exit from the portfolio, it is decision taken for himself, not for others. And that ultimately provides a lot of room to the portfolio manager to actually work for those investors who really come with risk appetite, with a goal of wealth creation for long term. And hence he keeps a concentrated portfolio, he keeps a focused portfolio. Weightages in an equity portfolio matter a lot when it comes to achieving high performance. So all that is kind of taken care in a PMS portfolio. Now, AIF is a very fine combination of mutual fund as well as a PMS, because in case of an AIF, you get the standardized NAV. You get it works on the concept of everybody working together, which in the terminology we call as a pool concept. Also, it provides the focus of a PMS, because because in an AIF there is a minimum ticket size of 1 crore. Hence, too many retail investors actually cannot enter into it. For each and every AIF scheme, there is it works on the concept of private placement. And investors, when they invest into AIF, it is like in a common pool, in a structure like mutual fund, you are investing, you will get a common NAV, but that the pool is not going to be prone to vagaries of various behaviors, because all like-minded people are ultimately investing into it, because it is a pool of informed investors. It's not that investors will come in and go out. And most of the AIFs, they work on the concept of the closed-ended fund. Today we have a lot of open-ended AIFs also, but primarily it works on the concept of a closed-ended fund. Another very important reason which differentiates the three asset class, these three structures of investing, is that what is the equation of skin in the game. In case of a mutual fund, I would say the skin in the game of the portfolio management team who are actually managing on day-to-day basis is low. In PMS, it is high. In AIF, it is very high, because in AIF there is a stipulated guideline that a fund management team needs to keep minimum 5% or 20 crores, whichever is lower, as a minimum corpus of their own money into the investment pool. So obviously, there are all these three different structures are equally good in their own context. It ultimately depends on what investor is trying to achieve, what investor is trying to chase, and they are different in terms of taxation also. So to cover that part, mutual funds, and PMS are more or less similar in terms of taxation. The only difference is that in case of a mutual fund, whatever buying selling happens in the portfolio, that really does not lead to any kind of short-term capital gain tax. But in case of a PMS, because everybody is directly holding securities, it leads to tax impact to each and every individual, the short-term capital gain tax of 10%. For long-term capital gain tax, it remains same. In case of an AIF, it works. The AIF provides the convenience to the investor in terms of taxation, taxation filing, because tax is actually so basically the AIF structure is the one which is accountable to settle the taxation, because it works on the concept of trust. And there, all the investors, they pool together, invest money together, and whenever investor ultimately redeems his money, he gets post-tax return. It is the AIF structure which is responsible to pay the taxes. So it is the post-tax and post-expense returns. So while understanding the performance of these three products, one needs to keep in mind you cannot compare these three products, because maybe an AIF product is publishing post-tax, post-expense returns, and mutual fund is showing you a gross return, or maybe AIF is showing you a gross return and PMS is showing you gross return, and maybe expenses are not kind of adjusted. So in terms of transparency, definitely mutual fund is most evolved product. So hence mutual fund is most transparent, most standardized. It is easy to select that product. But when it comes to PMS and AIF, they are less transparent, and that is the reason and at the same time, PMS and AIF are conducive structures to create wealth. So if there is a structure available to create wealth where the transparency is less, there needs to be somebody who needs to do some effort to ultimately to ensure that what is right, what is wrong, to kind of differentiate which are the best products and maybe which are not so great products. That is exactly what we do when we do PMS Aif World, when we created this platform.
Excellent. I have two follow-up questions on what we just heard. One is Sebi doing anything to standardize reporting of the returns? Like you mentioned, MFs are reporting it differently. PMS, AIFs may be reporting it before tax or after tax, like that. Is Sebi doing anything to standardize that so that it becomes easy for investors to compare the returns? And secondly, do you foresee, like if you have to foresee in the future, do you see more investments going towards PMS than AIFs, or more into PMS than MFs? So earlier, if 80% went into MFs, 20% into PMSs, is PMS gonna get more share or not?
So see, I can tell you, as Indian economy moves more towards knowledge economy, definitely the participation of PMS and AI products will increase. So when I started this discussion, I told you that my belief is that we have evolved from relationship based business models to information based business models, right? So when I was in a bank, it was more of a relationship based business model. And today, when we are doing these discussions, we are more towards information-based business model. So this is exactly what is the meaning of evolution of an economy to becoming a knowledge economy. So when we will move up the ladder, and we will move up the ladder in terms of information, investors will understand all these differences, and that investor who has a potential to invest into PMS, has the potential to invest into an AIF, will somehow understand the difference and will somehow understand which are the right PMS products, which are those PMS products. Because even if there is less standardization, it does not mean that standardization means that anybody is kind of publishing wrong numbers. All numbers are published on Sebi's website. It's not that numbers are wrong, but it's basically an understanding which is required at investors level to see it rightly. Because they could be presented in a manner which is difficult for investors to understand, right? One could do a wrong presentation of one's numbers. So as more and more platforms like us, like PMS Aif World would come, investors understanding about equity markets would go up, right? They would understand that yes, holding on to equity in their demat account is definitely a more evolved way of investing into equity market, because it gives you more ownership, it gives you more control, it gives you more I would say thought, because when you know that you're holding this particular company, this particular institution, and you know more about that company, and market goes down, you tend to feel not that bad. Unlike that, if you're holding units of a mutual fund, you're clueless, and with less understanding, you tend to kind of redeem it or sell it or change it at wrong times. So obviously it is more to do with informed investor. All informed investors who have potential to invest a larger sum of 50 lakhs, because minimum ticket size, which Sebi has rightly done, is 50 lakhs in PMS, and for AIF it is 1 crore. And obviously, if one is investing into one particular product, a large sum of 50 lakhs, investor ought to have a minimum corpus of maybe 2 crores, because one would not put everything in one product, right? So maybe a 20-25% will put in one product. So a larger investor, who we call as an HNI investor, right? If he is an informed investor, or if in future he will become more informed investor, he will definitely invest more in PMS and more in AIF with more information.
Excellent. Excellent. And did you cover that, the reasoning behind naming PMS Aif World?
Yeah, more or less I have covered. But the fact is that, when we are saying that we want to focus on performance, when we are saying high performance investing, and when we are saying for high performance, all these money managers who are portfolio managers, or who are founders of alternative investment funds, they are also equally setting up their portfolios for high performance. And this space is growing, and this space ultimately requires someone to deep dive to ultimately find out which are the best portfolios for what period. That is the reason we set up PMS Aif World. Ultimately, we are a wealth management firm, but we understand that every wealth management company has their own forte. We cannot do everything, right? So we are attracting those informed investors who really want to associate to follow a very, very simple equation. I'll give you that simple mathematical equation, which is basically clean debt. So clean debt is a diversified portfolio of mutual fund where return is not the focus, where focus is safety, right? A clean debt, maybe it is giving 4% return, 5% return, or 5.5% return, or 6% return. If you're lucky, like it has been in case of last 3-4 months, interest rates have fallen. Some of the debt funds have given great returns, but your objective is never return. So clean debt, that is the first aspect. The second aspect is a quality equity portfolio, quality equity, clean debt and quality equity. So what is the meaning of quality equity? Quality equity means you're holding shares, you're not holding units. First of all, quality equity, because you need to understand what you're holding. Second part of quality equity is that you're not holding too many companies, not a too much diversified portfolio. Because portfolio is too much diversified, it loses quality. Third aspect of a quality portfolio is that it should not be too much concentrated. It should be rightly diversified. Right. Fourth aspect of quality portfolio is that the portfolio correlation, amongst each other should be very fine. So you should know what is the coefficient of correlation, what is the beta of my portfolio, how much it is sensitive to the respective benchmark. So that is the quality portfolio. Fifth and foremost part is what is the average earnings of the portfolio that you're holding, the kind of companies that you're holding. Right. So all this makes a quality portfolio. So if you have a clean debt plus a quality portfolio, still you have started your journey towards wealth creation. It's not that you're going to achieve wealth creation, it's just the first step. Now the story starts from here, right? Maybe this is 50% of the story. Remaining 50% of the story will happen over a period of 5, 7, 10 years, and that is where you require the third part of the equation, which is high conviction. You need to have high conviction throughout the period, because a lot of scenarios will come where you will feel that the debt which I'm holding is only giving me 4 or 5%. There are other debt funds, credit funds, which are running very fast. Or the time will come where you will say that I'm holding a quality portfolio, but suddenly the theme is running, or suddenly some small and mid caps which were too beaten down without any earnings behind them, but they are running, right? So you require high, and maybe you do leave that equation of clean debt and quality portfolio. So at that point of time, we require high conviction. We provide that high conviction. So this platform, when we have created, where we are doing ongoing webinars, this is what provides high conviction. And it's not, we are doing maybe twice a webinar for the entire ecosystem, but with our clients, it's throughout we are talking to them, we are interacting with them in terms of our newsletters, in terms of our one-on-one, meetings on Zoom these days. But that high conviction is the third and foremost part, which is the value add that we are doing. And it is the quality, data oriented analysis back discussion that why you should not feel bad and why you should not, kind of think jittery about markets or about your portfolio when the portfolio is not performing. Or it could be other ways around. Actually the portfolio that you are holding that today is no more a quality, because a quality portfolio at times may require some kind of review, right? So that also is an ongoing thing that you need to do. So clean debt, a quality equity, and high conviction is equal to compounding, is equal to wealth creation. This is the entire equation that we want to ultimately deliver, and that is the reason we have created PMS Aif platform, and that is the reason we have kept the name as PMS Aif World.
Excellent. Thank you so much. Over to Sapna for the next question.
All right. Thank you, Akhil and Kamal. I think we've spoken quite a bit on investment philosophy, on what PMS Aif World does. I think, with the concluding question, Kamal, before we open up the floor for Q&A from our attendees, I think, wearing both your hats, that of the advisor and that of a product reseller, what are the 3 products on the equity side and 3 on the debt? And these are specific products that today you would recommend to investors that sets them up for quality wealth creation over the next 5 to 7 to 10 years.
Okay. So, talking about product is a very personal, very private discussion, right? So, every client has a unique risk profile, unique time horizon, unique goals. But in general, I can tell you, if I were to invest for myself, right, what are the top products that come to my mind in terms of debt, equity, as you said, in various structures of mutual funds, PMS and AIFs. So, okay, in debt mutual funds, I would say, top 3 products that come to my mind in the current context are products like ICICI Savings Fund first. Then the second product that comes to my mind is Axis Banking and PSU Debt Fund. The third product that comes to my mind is Kotak Low Duration Fund. I will give you a brief rationale behind these 3 products. These 3 products offer around YTM of 5%. So when I said in my detailed conversation that our belief is to have clean debt portfolio. So this is a portfolio which provides which is a combination of those debt mutual funds which are fairly large in terms of AUMs, which have low expense ratio, which have fine, I would say, credit quality of the portfolio. The credit quality is kind of close towards AAA, and the asset size is very large. So this is a clean debt portfolio. Now, talking about equity, within equity, I would say in mutual funds, 3 mutual funds that come to my mind. Let me think. Yeah, the first will be, for example, a Mirai Asset Focused Fund, which is one fund that is a focused fund, would have around 30 companies. It is a focused portfolio. As I mentioned in my earlier discussion, that the portfolio's focus is very, very important when it comes to investing for high performance. And a portfolio which is a blend of good, I would say, good large cap and mid cap stocks. So Mirai Asset Focus is for one portfolio that comes to my mind. Second portfolio that would come to my mind is Mirai Mid Cap. Mirai Mid Cap is another very good portfolio, which is a portfolio of around 50 companies, a well diversified portfolio. When it comes to investing into mid caps, portfolio definitely should be diversified. And within that, the price to earning of the portfolio is around, I think, 13, 14. So which is also very rare. If one checks it, one will find it a very appealing aspect in that context. So Mirai Mid Cap is another product that comes to my mind in the current context. And third, if one is wanting to actually invest into large cap, Axis Blue Chip is a very good fund. One may think of investing into an index fund, but if one invests into an Axis Blue Chip fund, it's a better option because it is a focused basket of, I think, 25 companies and chosen very selectively from the large cap basket, and is a very, very good product. So again, I would say that diversification should be kept in mind. Portfolio should not be too much diversified. Portfolio should not be too less diversified, and it should not be, it should not lose focus. So if one creates this combination which I have just highlighted of debt and equity product, I think that's very good. Apart from this, in case of a PMS, I would say 3 PMSs that come to my mind One is Marcellus Considerant Compounders. Marcellus Considerant Compounders is a portfolio which is a combination of concentrated 13, 14 such companies which just purely focus on earnings. The belief of the portfolio manager, the founder of Marcellus, is that it does not matter what is the valuation when you are investing in the market leader. And that too, when you are not just focusing on selecting the market leader on the basis of the revenue, but also on the basis of their market share in the profit pie of that respective product category. So there are a lot of companies we know, who have a large market share in the revenue pie, in the sales pie of the ultimate product category, which could be, for example, Maruti, which could be, for example, HUL. In their respective product category, they have a large market share in terms of owning the revenue pie. But there are few companies which also equally own the profit pie, the earnings pie, and that is what adds a lot of cash year-on-year basis to their balance sheet. And that is what Mr. Saurabh Mukherjee, when he says ATM machine or money-making machines, to all these companies, a portfolio which is a portfolio which one can invest for long term to build wealth, because it is a concentrated portfolio of 12 to 14 such companies which are absolutely market leaders in their respective profit pie and difficult to disrupt in that context. Second portfolio which is different from this context, which has a different philosophy, is of IIFL Multicap. Now, that portfolio says that it's good to invest into market leaders which are owning profit pie, but that is not the only area where money can be made, because when it comes to investing, you need to discover something which is not discovered, because these companies where there is profitability and there is a market share, these are already discovered companies. But yes, such companies are important. So IIFL says that we see market divided in 4 types of companies. One is secular companies, those businesses which definitely as would be covered by something like Marcellus, which is like Asian Paints, Bajaj Finance, HDFC Bank. So which in their respective category would own not only the revenue pie, but also considerably own more than 70% of the profit pie. But that cannot be the entire portion of the portfolio. So IIFL says, I will put 40% into the secular basket. This is the secular basket where there is predictability of earnings. I will put 40% there, but not more than that. However, there are 3 more baskets where there cannot be secular earnings forever. It's rare to have a secular company in other 3 baskets. The other 3 baskets are like value basket. So in a value basket, you cannot have a secular business, because if the business is not secular, that is the reason it is a value business. It comes in the value basket. The other two baskets are defensives and cyclicals. Cyclicals are like auto, infrastructure, banks, financials, basically. So in cyclicals, it is also linked to economy. When economy is doing well, cyclicals will do well. When GDP is coming down, cyclicals will not do that well, and hence that cannot also be a secular basket. But yes, in banking, for things like HDFC Bank comes into secular basket. It definitely happens. Exceptions are there. That is the reason HDFC is the favorite stock. It's given best returns because it's part of a cyclical business, but it has attained secular earnings, and that is the reason it's a product, it's a stock which we will find in most of the portfolios. So basically, IIFL Multicap says that they will create a portfolio by putting 40% into secular basket, where earnings is the core focus and predictability of earnings is the core focus, where we know there is earnings and there is a predictability of earnings, and there is a leadership in that and in the product category in terms of owning more than 70% pie in that earnings. Remaining 60% goes into selecting companies where there is a very, very high chances of re-rating, because earnings are going to improve. There were reasons which can be understood which were responsible for fall in earnings, and those reasons kind of point to the fact that today it's a chance to invest and make quick money, because the earnings will come back and market will re-rate and stock prices will go up. And to discover those companies, one focuses on a lot of other aspects, that yes, company has a track record, company has a good corporate governance, good management, leadership in their product category in terms of maybe revenue pie, maybe the leadership is only in terms of sales. But yes, for example, ICICI Bank, within the corporate banking space, has leadership, has good corporate governance. There was fall in earnings because ICICI Bank had to do provisioning in terms of NPAs in 17-18, and then there was a change in leadership that led to some slowdown, and then now we have a COVID that is impacting. But otherwise, it has all the traits in cyclical baskets to get re-rated, right? So this is one example which they would have. So IFL multicap is the second portfolio in that context. Similarly, like I explained, the cyclical basket, there is a defensives basket. So they would pick stocks in the defensives basket, and ultimately IFL multicap would say that we will put 40% in the secular basket with the horizon of 3 to 5 years. In the cyclical baskets, out of these three quadrants, we will put around 60% with the horizon of 1 to 3 years. Obviously, this portfolio will see some more change in stocks, and hence beta is also high. So this portfolio is high on risk. If one is trying to make a combination, maybe a portfolio of Marcellus and IFL multicap is a good combination, because Marcellus is a low beta portfolio and IFL is a high beta portfolio. The third portfolio that comes to my mind in PMS is White Oak, because White Oak is a portfolio which says that we are going to invest in quality like Marcellus, but we are also going to be cognizant about the value. So quality at a reasonable price. Also at the same time, it is a very well diversified portfolio. It is a portfolio of 35 to 37 companies. If one is wanting to not take a very concentrated risk which comes with every PMS, and at the same time one wants to own equities, then maybe White Oak portfolio is a very good portfolio, because it's as diversified as mutual fund, but unlike mutual fund, it does not give you units, but it gives you owning of your own stocks. So these are the three portfolios that come to my mind when it comes to PMS. And now coming to the last category, I know I have taken too much time. AIF is a third category. In the third category, again, Carnelian is one product, one company that comes to my mind. Acura Cap is third company that comes to my mind, and White Oak is the third company that comes to my mind. Which have credible portfolios, which one should understand and then invest. And apart from this, in the AIF, there is a long short category where ITI is one product, Edelweiss has another product, Vendors has a third product. So likewise, these are the products that come to my mind, which I would say are fine products in respective structures of equity and debt.
Thank you, Kamal. I think that's been a very, very good discussion. We've spoken across topics, both from investment philosophy to suitability of products and to specific products. And maybe if Akhil wants to add a few words, I think I'm cognizant that there are only 6 minutes left, so we should actually leave some time for some question and Q&A from the floor. Akhil?
Yeah. I think from my side, I've learned a lot. And like Kamal, you mentioned on high conviction, and this call made me realize that high conviction is not only important for the company that you're investing in, but also on the advisor that is assisting you in that journey. So, and this call definitely helped me personally, get more comfortable with my choice on the advisor. So, I think that is all I had to say. Are there any questions that are?
I think most of the questions have been answered, but I would just like to add one aspect that, though we have spoken about a few products, but these are just that we have just shared these few names, but these are not our recommendations. It should not be construed as any kind of advice. It's nothing to do with recommendation. It is basically discussing various products that come to my mind, top of my mind recall, based on my conviction for these products, based on my understanding for these products. But ultimately, if any investor is listening to this entire discussion, one should do one's own research, or one should deep dive. One can contact us. We will definitely help one to understand one's risk profile, and then accordingly help him find out which is the right, most suitable portfolio and product for that individual.
Excellent. I think if there are no more questions, let me check. Maybe I'll ask one last question on behalf of.
Sure.
Do you see PMS Aif World mostly for advising like HNI clients, or is there scope for some small term investor who wants to invest maybe 25-30 lakhs?
So, at the moment we are a small team. We are a team of around 8 people, and there is a bandwidth thing, which limits us. So that is where, we are constrained in that context. A lot of investors contact us, and we spend quality time with each and every individual in understanding that client. That is the reason we have we consciously say no to anybody who wants to invest less than 50 lakhs as a ticket size, right? So obviously we are happy to talk to that individual, happy to share our thoughts and provide some kind of wisdom if that individual wants, and we really do that, and we really don't mind that. But when it comes to actually professionally associating in terms of putting our skin into it, in terms of doing servicing on ongoing basis, we always try to ensure that it is a minimum investor portfolio of 50 lakhs. So today, when we say that we have around 115 clients, overall assets are more than 400 crores. So obviously because we are consciously focused on large investors. We're consciously focused on those investors where we can see a lot of value addition, possibility of a lot of value addition. But yes, as our team size will grow, as I said, there are a lot of plans which it would be not right to share in this forum, because that's personal to us, and things evolve, and we are also kind of doing our team discussion kind of every month on improvising every month, and strategic discussion on what next. So obviously over a period of time those things will also happen.
Excellent. I think we are almost out of time, so I'd like to thank Kamal for taking this time and letting us know you and PMS Aif World a lot closer. And Sapna, any closing comments from your side, and then we close the call?
No, I think likewise. Thank you, Kamal. And I hope that everyone who was able to join the call was able to take away both from Akhil and my comments and our confidence in PMS Aif World in terms of helping us with our wealth creation journey. And, I encourage you all to reach out to Kamal to actually have a prelim discussion on how they can help you.
Thank you so much. Thank you for giving me this opportunity. And I would like to end by saying that do not just invest, always make informed investment decisions. That's the most important aspect. Thank you everyone for joining. Thank you, Akhil. Thank you, Sapna. Thank you.
Thank you.
Thank
Bye-bye.
you.